from WBRN Radio and on the Bostonred Network. Numbers Man. This is our macroeconomics program. This week in economics on the 9th of February 2020. Last week we did not have our normal production of This Week in Economics. We will more than make up for it this week. We have a lot of things here, or items I should say, the conference board. We have some commentary and an article from Reuters. We don't have our friends at CSNBC this week around, but we will talk about what payroll gains need, and benchmark revisions. This is from the Reuters article. And piggybacking on the State of the Union address, the state of the blue-collar vote. Is there a blue-collar boom? We'll talk about that. And we will have the actual figures from our friends at the Bureau of Economic Analysis. And, of course, the Labor Department. We will explain some revisions. We'll go into detail on that particular item. The coronavirus continues on. 800 and, I believe, 14 or so it probably is by now. People have died. Over 34,000 people have been infected. And just heard on radio that from BBC that we have 5 infections in France, in the Lyon area there at one of the ski resorts. Now, we haven't found out exactly how these people were affected or to who the infected person was. It was in a cluster chateau, there, and we'll find that out. And we are now beginning to see the impact, the financial impact on China. Some of the predictions was early that at least 1% of GDP in China would be affected by this particular virus. It not only affects China, but it affects Hong Kong, Macau, etc. across there, and the supply chain, which is very important there. Hyundai evidently is going to cease production of some of their cars because of the supply chain. Starbucks stores are closed in China, and various other manufacturing arms there are closed. In fact, I was talking to a guy, I think it was Friday, that ordered something from China, and they informed him that it would take 2 months or more to arrive due to the reduced number of flights out of China. And a lot of that material would go into the cargo bays. That is not happening and coming by ships. Incidentally, goods out of China is not infected with the coronavirus there, period. I mispronounced it. Sorry about that. Coronavirus and incident, and also they are going to come up with a permanent name for that particular virus, and where we'll be referring to it as a name. Some other naming regiments, such as SARS, that was okay. Then they had MERS, that was to the Mideast, basically unfair there. And then we had the swine flu that had nothing to do with swine. In Egypt, a country that by and large does not eat pork, killed hundreds of thousands of pigs that were quite unnecessary. And we're also getting reports that children on playgrounds in the United Kingdom, Chinese students, are being bullied from a racial standpoint, that they are potential carriers of this particular virus. So there are some downsides to it. We have not got the economic downsides as of yet. We are now looking at some climate issues here. We're kind of shifting gears in terms of construction. A winter that was not as cold as normal, so construction boom. Let's go to Reuters now, and we'll look at their article here. And let's see, just a second here. Get my glasses on here. This is U.S. payroll gains seen pickup benchmark revisions on the spotlight. That is due to some revisions in how we count things. U.S. growth will likely picked up in January. This was an article written before the numbers were released. Booms in hiring in weather-sensitive sectors, including the economy, will probably continue to grow moderately, and that's the key. We hear the word more moderately. One of the listeners asked me about the Beige Book. We'll go back and revisit the Beige Book. I have to look and see when the next one is out. Nonetheless, the Labor Department, their report, we'll get to that, is expected to show job gains from April of 2018 through March of 2019 were not as robust as originally estimated. Period. And we'll get to that. The job report will support expectations that economic expansion is going to continue again at a moderate pace, is what people are saying. That is from somebody at Wells Fargo Securities in Sam Bullard in Charlotte, North Carolina. But benchmark revisions will show weaker momentum in the labor market, which should weigh on market's expectation for payroll growth going forward. We won't get into the numbers here, and the ADP there, we don't have the Institute for Supply Management showed it. Its measurements of service industry employment fell for a second straight month. That is one of the things that we usually use there, and we'll get in a future presentation. And the manufacturing gauge is in a contradictory situation. Period. And this is the government last August estimated the economy created 501,000 fewer jobs in 12 months through March the 19th than previously reported. That's 500,000 jobs, the biggest downward revision in the level of employment in a decade. 10 years suggests that monthly job growth in each of the months from April of 2018 to March of 2019 could be downgraded by around 45,000 jobs. Now, the economists say that the largest revision suggests that the company's birth dip model, which it uses to calculate the number of jobs from new businesses and closing, is flawed. Historically, payrolls have tended to be overstated when the trend in growth is weakening, and vice versa. That is from Kevin Cummings, a senior economist at NatWest Market in Stamford, Connecticut. Revisions could have a meaningful impact on the assessment of the labor market. These are things you'll see more and more showing up because the models are being changed to reflect what the market actually is. A slowdown in job growth, we're back to Reuters, is blamed on worker shortages and ebbing demand for labor. Even though employment growth has slowed, the pace remains well above 100,000. It was above 200,000 there, and we're skipping some of this because we'll get to it. In January, 3.6 was the employment rate. We don't look at it as much, and this is one of, you'll see various forecasters move to that situation. The jobless rate, anecdotal evidence of worker shortages have not spurred significant wage inflation. Average hour earnings are forecast to rise at 0.3 last month. We will get to more of that. And the Chairman Powell said last month the U.S. is low labor force participation relative to those of other advanced countries represents more labor supply that may be holding down wages. Economic growth in 2019 was 2.3%, the slowest performance in 3 years after logging at 2.9 in 2018. That was due to the tax cuts in 2017. That has disappeared. Growth this year is seen around 2%, just above the 1.8 economists said, and a lot of that will depend on the damage done by the virus. Period. Construction industry added jobs in December, increased by 20,000. That was in December, and we'll get to that later here. And manufacturing is staying about the same. One of the things that's impacting manufacturing is the 737 MAX jetliner. That's from Boeing, or Boeings as we used to say when I lived in Seattle. And one of their big suppliers there, Sprint Aerosystems Holdings, Inc., said last month it plans to lay off more than 20% of its workforce in Wichita, Kansas. Government payrolls are forecast rising by 10,000 in January. We won't get much to that, as hiring of census workers had impacted on that. Let's go to Boeing's here, and we can, I think, look at a little bit of this. I reviewed this article earlier, and we'll see where we are, and then we'll get back to some of the locations affected by this. Suppliers are shedding jobs and capacity to cope with the halt in the 737 MAX output, while shaving off chaos. Aerospace executives worry the industry might be unable to ramp factories quick enough when the plane wins approval to fly again. Well, there's no doubt about that. Boeing is struggling to restore public confidence, and that should be recovered from the biggest crisis since its founding in 19. Losing payments and workers in a tight labor market heaps pressure on Boeing's, which involves hundreds of suppliers, more than half of roughly 400,000 parts for that built in the Seattle area. Such concerns dominate the Pacific Northwest Alliance Conference north of Seattle. When I lived in Seattle, Boeing's was it. Microsoft and the other tech industries were not in Seattle at the time. And this is becoming more of a scene in areas where it's dominated, such as the Pacific Northwest and like Wichita, Kansas, and where some of the suppliers are. So this is the Boeing story. Let's get to the blue-collar sector of this, get a little different view before we go to the hard and cold numbers here in just a second. This again by Reuters, blue-collar boom. College grads, baby boomers, big winners in the Trump economy. This goes back to the State of the Union address there. Wealth held by the poorest half of American households increased 3 times as fast as the wealth held by the 1%, claims by the administration. That is true. On the average, Americans have seen a 17% jump in household wealth since the Trump administration entered office, while wealth at the bottom half has increased by 54%. This is a blue-collar boom. The biggest winners on a dollar basis were the familiar groups, Europeans, college graduates, people born during the baby boom, 1946 to 1964. Since December of 2016, that was the last full month that Barack Obama was in office, aggregated household wealth has increased by $15.8 trillion, but the vast majority went to groups that had tended to accumulate wealth in the past. Even with the 54% increase in household wealth under the present administration, the poorest half of American households, around 64 million families, still have just 1.6% of household net wealth. Net wealth combines the value of assets like real estate, stocks, subtracts liabilities like a mortgage and credit card balances. Incidentally, credit card balances were up in December because America's bottom 50% are starting from such a small base, given the enormous disparities in wealth in the United States. Even large moves in their fortune do little to dent the overall distribution. Bernie Sanders has talked about this. In dollar terms, as of the end of September 2019, the latest figures available from the Fed, the combined net worth of the poorest half of families were at $1.67 trillion out of a total U.S. household net worth of $107 trillion. Here's what the Fed's distribution finance accounts have to say. Historically, 17% of growth in household wealth over 11 3-month quarters, or nearly 3 years, is pretty standard. There has been 110 such periods since the Fed data series began. That was in the mid 1989 on the Paul Volcker. The most recent ranks 55th, squarely in the middle. On a quarterly basis, compound growth in household wealth since 1989 has averaged 1.39%. Under the present administration, slightly less at 1.34%. The bottom half of households saw their net worth rise under the present administration from 1.8 trillion to 1.67 trillion. That compares to 18% rise of the top 1%, who control roughly a third of total household wealth in the U.S., or about $34.5 trillion. Even after these gains that worked out to average net worth of about $26,000 for the bottom half of households versus $27 million for the ones at the top. Much of the increase amongst the bottom half was due to increase in real estate, not stocks, after resurgence in home ownership rates. That's in 2016. Under President Obama, wages for lower skilled workers have of late been rising faster. A lot of that is due to the campaign for 15. January non-farm payroll data shows a bigger than expected jump in overall employment, boosted by increase in construction jobs. But it takes time for income to be saved and translate into wealth. Since the administration took office, household headed by college graduates captured 75% of the net worth gains. That's around 11.88 trillion. They represent a third of all households, according to the Fed survey. We'll have the Fed survey next week. Household heads by high school graduates, a group that would seem to be more and more in the back of the employment lines, lost 0.4 trillion net worth during the time of the administration. Households represents about a fourth of the total. So the baby boomers, households headed by boomers, that's 1946 to 1964, did not get fooled again, as the 1971 rock anthem pledge. The title of the speech was "The Great American Comeback." It could just as easily been "Okay, boomers, what about the rest of us?" The baby boomers under the Trump administration, which DJ Trump himself is a member, captured 10 trillion of the recent wealth, or about 2/3 of the total. The Fed surveys demographic estimates as of 2016, and the population would change slightly since then. In 2016, about 36% of household heads. In the case of mixed couples, the Fed considers the man to be the head. In same-sex couples, it's the oldest of the two. Were headed by a member of the baby boomers. Wealth accumulation accumulates with time. Older people would tend to have a larger base to start with, but for millennials, those born between 1981 and 1996, the last 3 years of the booming market, has meant an extra $500 billion only spent across 20.6% of households. Gen Xers, now they were the ones born from 1965 to 1980, got 21% of the gains, made up roughly 26% of the households. The pre-baby boomers, that's a solid generation, got a total of 16% of the gains, roughly in line with the group share of households. Analysis by race, data told a familiar story of inequality. 85% of recent wealth gains occurred to 64% of the households that self-identified to the Fed as European. About 4.6% of the wealth went to 14.5% of the households that identify as African Americans, 3.8 to 10.1% of the households identified Latinos. So that's kind of how that particular situation adds up. A lot of inequality there, and inequality will continue. Let's go now and start to do the raw numbers. We'll start here with no, we won't. I think we did this. Personal income outlays. We did that. Sorry about that. Well, we'll do the job number before we do international trade. These are two of the things. We'll do the employment situation, which we were actually talking about. This is released on for January 2020. This is released on Friday, I believe. Actually, yeah. On Friday. Anyway, the employment situation, January 2020. Total payroll employment rose by 225,000 jobs in January. They called non-farm payroll. The unemployment rate was at 3.6. As the Bureau of Labor Statistics reported this, notable job gains occurred in construction, healthcare, transportation, warehousing. The new release presents statistics from 2 monthly surveys. The household survey, as we normally record here, measured a labor force status, including unemployment by demographic characteristics. The establishment survey measures non-farm employment, hours, and earnings by industry there. And these are some technical notes. Establishment survey data has been revised as a result of the annual benchmark process and the updating of seasonal adjustment factors. In addition, several changes have been made to the household survey, including annual updates of population estimates. The household survey, both unemployment rate at 3.6, the number of unemployed persons at 5.9 million, little change in January. Amongst major groups, adult men at 3.3%, adult women at 3.2%, teenagers at 12.2%, Europeans at 3.1%, African Americans at 6%, Asians at 3%, Latinos at 4.3%, showed little or no change over the month. Amongst the unemployed, the number of re-entrants, now that's something new, to the labor force increased by 183,000 in January to 1.8 million, but was little changed over the year. Re-entrants are persons who previously worked but were not in the labor force prior to the beginning of their job search. The long-term unemployed, that's people that have been jobless for 27 months or more, at 1.2 million, was unchanged in January. And they account for 19.9%, almost 20% of the unemployed. After accounting for annual adjustments to population controls, the civilian labor force rose by 574,000 in January. Labor force participation rate edged up 0.2% to 63.4. The employment population ratio was at 61.2. Little changed over the month, but up 5-10 percentage points over last year. The number of persons employed part-time for economic reasons at 4.2 million was essentially unchanged. Number of persons marginally attached to the labor force, 1.3 million, changed little in January. Individuals were not in the labor force but were available for work and looked sometime during the prior 12 months. They were not counted as unemployed because they had not searched for work for 4 weeks preceding the survey. Anyway, discouraged workers, 337,000 January, little change there. The establishment survey, a non-farm payroll employment by 225,000, compared with an average of 175,000. That's in 2019. Notable job gains occurred in construction, healthcare, transportation, and warehousing. In January, construction employment rose by 44,000. Most of the gains occurred in Pacific trade contractors, with increase in both residentials, that was 18,000, non-residential 17,000. Component construction added 12,000 jobs per month in 2019. Healthcare added 36,000 in January, with gains in ambulatory healthcare services at 23,000. Medical centers at 10,000. Healthcare has added 361,000 jobs over the past 12 months. Transportation warehousing increased by 28,000 in January. Job gains occurred with messengers, couriers, 14,000 there. Warehouse and storage, 6,000 over the year. Employment in transportation warehousing increased by 106,000. Leisure and hospitality continue to trend up, 36,000 there over the past 6 months. The industry has added 288,000 jobs. Employment continued upward in professional business services, 21,000 in January, increasing by 390,000 over 12 months. Manufacturing changed little, negative 12,000, has shown little movement there, and motor vehicle parts lost 11,000 jobs over the month. Employment in major industry, including mining, wholesaling, retail, information, financial activity, and government, little changed. January's average earning for workers on private non-farm payrolls rose by 7 cents. $28.44, that's the average. Over the past 12 months, the average hourly earning increased by 3.1%. The average hourly earning private sector production non-supervisory workers, $23.87. That's almost $10 above the fight for 15. The average work week for workers was unchanged at 34.3 in January. In manufacturing, the work remained at 40.4 temps there, while edging down 1 temp an hour to 3.1. Changes in non-farm payroll employment in November was revised up by 5,000 from 256,000 to 261,000. That was in Q4. Change in January was revised up by 2,000 to 145,000 from that. 247,000, with revision in the combined was 7,000 higher than previous reports. Monthly revisions resulted from additional reports received from business and government agencies since the publication. The annual benchmark process also contributed to November and January revisions. After revision, job gains averaged in the last 3 months to 211,000 jobs. The next job report will be released on March the 2nd. Now, some changes affected with this release. 2 not seasonally adjusted series previously displayed in the summary table. This is a household survey. A person marginally attached to the labor force and displaced workers have been replaced by new seasonally adjusted series. The new seasonally adjusted series are available online, a database back to 1994. Not seasonally adjusted data for persons marginally attached to the labor force are discouraged workers will be continued published in table A16. Persons marginally attached to the labor force and discouraged workers are inputs in the 3 alternative measurements of labor utilization. Effective with this new release, data from U4, U5, U6 will reflect adjustments. Changed historical data were negligible. Revised data to 1994 available online. Effective with the January 2020 occupations estimate in Table A3 reflects the introduction of 2018 Census Occupation Classified section there. Beginning in January, marital status estimates are not strictly compatible with early years. Estimates of married persons now refer to those in opposite sex and same-sex marriages. Prior to that, referred only to those in opposite-sex marriages. Persons with same-sex marriage spouse were previously classified in marital status, such as women who maintain families. These changes affect marital status estimates in the tables. Note that not all marital status categories are present there. The BLS has not separately tabulated estimates for people with an opposite-sex spouse and persons with same-sex spouse. So they're working on that. That material will come out. Revisions to the establishment survey. The counts derived principally from the quarterly census employment wages, which count jobs covered by the UI, unemployment insurance tax system. The benchmark process results in revisions not to seasonally adjusted data from April of 2018 forward. The BLS revised series seasonally adjusted data from January 2015 forward. Total non-farm levels, employment levels from March 19 were revised down by, and this is where the Reuters article came in there, by 519,000. That's a negative 505,000 on a not seasonally adjusted basis, or negative 0.3 The absolute average benchmark revision for the past 10 years is 0.2%. The year-over-year change in non-farm for 2018 was revised from 2,108,000 to 2,000,096 season adjusted there. So these are some of the things that have happened here, some of the revisions that have happened here, period. And some of these numbers in 219 is in this particular frame. Effective with data 2020 unpublished population estimates were incorporated into the household survey. Population estimates for the household survey are developed by the U.S. Census Bureau. So these are some of the things going in there. The adjustments to decrease the full size of civilian non-institutional population in December by 811,000, the civilian workforce by 524,000, employment by 507,000 there, unemployment by 17,000. And this is some of the things going on here. Population controls for veterans, which are derived from the Bureau of Veteran Affairs. Population models are updated periodically, but also were updated in the release of 2020. Historical data was not revised, and this is some of what is going on here. I'll just append this so we'll make it easier for people, and that was the reason we presented the Reuters model. Okay, so we can move along here. International trade and goods. So we'll get to this one right here. Census Bureau, U.S. Bureau of Economic Analysis announced today that good and service deficit was 48.9 billion in December, up 5.2 billion from 43.7 billion in November, revised there. This is the deficit, 11.9% there. Exports were at 209.6 billion. That is 0.8% there. Imports at 258.5 billion. This is next release, of course, will be in March. December's exports were 209 billion and 1.6 billion more than in November. December's imports were 258.5 billion. That's 6.8 billion more. The December increase in goods and services deficit reflects an increase in goods deficit of 5.1 billion to 69.7 billion, a decrease in service surplus of 1/10. Goods and service deficit decreased by 10.9 billion are 1.7% from 2018. The 3-month average exports increased by 9 tenths to 208.2 tenths billion. That was in December. The average imports decreased by 1 tenth to 254.8 billion. Year over year, this is the service deficit decreased by 10.4 billion. Exports increased to 2 tenths billion from December 2018. The average import decreased at 10.2 billion there. Export of goods increased by 1.3 billion to 337.7 billion in December. Exports of goods on a census basis increased by 1.3 billion. Industrial supplies and materials increased by 1.7 billion. Crude oil increased by 1.7 billion. Other goods by 1 billion. Auto parts, engines, etc. decreased 1 billion. Passenger cars decreased 6/10 billion. Net balance of adjustments increased less than 1/10 billion. Export of services 3/10 billion, 79.9 billion. Other business services increased 1/10 in this exports year. Industrial supplies increased at 4 billion. Crude oil increased at 1.7 billion. Non-monetary gold increased at 6/10 billion. Other petroleum products increased at 6/10 billion. Other goods at 1.2 billion. And imports of services increased at 4/10 billion to 51.1 billion in December. Travel increased at 2/10. Transportation increased at 1/10. Real goods, and this is in 2012 dollars. Real goods deficit increased by 4.3 billion to 80.5 billion. Raw exports of goods increased by 1.5 billion to 149.3 billion, and real exports of goods increased by 5.8 billion to 229 billion. In addition to revisions for source data in November's statistics, the seasonally adjusted goods data were revised for January through November, and the revisions were export of goods were revised down 7/10 million. Export of services were revised up by 1/10 billion. Revision to November's imports of goods were revised up less than 1/10 billion. Imports were revised up there. Now, by select countries, we don't hear much about this. In billions of dollars, with South and Central America at 4.6 billion, Hong Kong at 1.9, Brazil at 9/10, OPEC at 7/10, United Kingdom at 6/10. We expect that to change. Singapore at 5/10, Saudi Arabia at 3/10. The deficits were recorded in billions, with China at 25.7, the EU at 14, Mexico at 9.4, Germany at 5.5, Japan at 4.4, Canada at the same 4.4, Italy at 2.9, Taiwan 2.4, Korea and the Republic of Korea at 1.9, India at 1.7, and France at 3/10. Deficit with Canada would increase 2.4 billion to 4.4 billion in December. Exports increased 1/10 billion to 23.9 billion. Imports increased 2.5 billion to 28.2. Deficit with Mexico increased 9/10 to 9 billion 0.4 in December. That's the deficit anyway. The exports decreased 6/10 billion to 20.2 billion. Imports increased at 3/10 to 29.6 billion. Deficit with Japan decreased by 1.3 billion to 4.4 billion in December. Exports increased 9/10 billion to 6.7 billion. Imports decreased to 11.1 billion. That's with Japan. And the annual summary for 2019, the goods and services deficit was 616.8 billion. That's down 10.9 billion from 627.7 billion in 2018. Exports were at 2,499.8 billion, down from down 1.5 billion from 2018. Imports were at 3,116, down from 12 billion there. And so there's some of the estimates here. I'm not sure it will appear. Just we may do it. I don't want to give it too much here. But this way you can go and get the entire story. And that is where that story ended. Let's go to the conference board now, and we'll get their input here. This is a conference board. Their conference consumer confidence survey index increased in January. The conference board index in January followed a modest increase in December. The index stands at 131.6. That's up from 28.2, an upper revision in December. The present index, situation index, based on consumer assessments of current business and labor markets, increased from 170.5 to 175.3. The expectation, based on a short-term outlook for incomes, business, and labor markets, increased from 100 last month to 102.5 this month. Consumer confidence increased in January following a modest advance in December, driven primarily by more positive assessment of current job market and increased optimism about future job prospects. That is from Lynn Franco, Senior Director, Economic Indicators at the Conference Board. Optimism about the labor market should continue to support confidence in the short term. As a result, consumers will continue driving growth and prevent the economy from slowing down in early 2020. The monthly consumer confidence survey, based on probability design random samples conducted by the conference board by Nielsen, the same people that used to monitor and still do your TV programs, a leading provider there. Consumer assessment of current conditions improved in January. Those claiming business conditions are good increased from 39% to 40.8%. Those claiming are bad decreased from 11% to 10.4%. Consumer appraisal of job market also improved. Those saying jobs are plentiful increased from 46.5% to 49%. Those claiming jobs are hard to get declined from 13% to 11%. Consumers were more optimistic about short-term outlook. The percentage of consumers expecting business conditions will improve over the next 6 months with virtually unchanged. That's 18.8%. Those expecting conditions to worsen declined from 8.8% to 8.4%. Consumer outlook for the labor market was more upbeat. The proportion expecting more jobs in the months ahead increased from 15.5% to 17.2%, while those anticipating fewer jobs declined from 13.9% to 13.4%. Those regarding their short-term income prospects, the percentage of consumers expecting improvements declined from 27.7% to 22%, while the portion expecting a decrease was virtually unchanged at 7.7%. So that is the source of the survey here. The next one will be out on the 25th of February there. So that's a little bit of what is going on here. Let me just see if I can get to the BBC here on job growth. Hasn't changed that much, and then we'll do the numbers. The headline here, the BBC, is U.S. Job growth beats expectation. Well, the expectations were a little bit low. We heard that some people had the expectation at less than 200,000 jobs. Hiring at construction firms helped to drive up the gains. The unemployment rate, well, that we're not really particularly concerned about. Our data has outperformed substantially in recent months. Shows no sign yet of fading. That is from Aaron Stephenson, a chief economist at Pentagon Macroeconomics. U.S. growth at an annual rate of 2.1%. 2.1% was looked upon in the 2016 campaign as being poetry. They were looking more at 3.5, and perhaps even 4% there. So we have that working here. The re-election of a president. There is a model by Professor Amowitz. He's at the Emory University. And the time for change model, basically what it says, the economy is good, the president's chance of re-election is better. Now, revisions of prior reports also found the U.S. happy, and that's 514,000 fewer jobs were created. That's between April of 2018 and March of 2019 than originally estimated. This marks the biggest statistical downgrade since 2009. That was the Depression. Today's jobs beat expectation. The Fed's recent decision to hold rates seems justified in the face of rising job numbers, low unemployment, mild wage growth. That's from Richard Fry. He's a UK managing director at stockbroker Charles Schwab. Anyway, however, with concerns around the coronavirus, intensifying continual trade talks, Brexit. Now, these are some items you've not heard much about. Brexit, it is of concern to the UK and its trading partners. They will be negotiating it until the end of 2020. And incidentally, in Ireland, they had an election on Saturday. There are three political parties. They're pretty much evenly divided, including Sinn Féin, and they are talking there about income inequality, a big part of what is going on actually throughout the world. So we'll see where the corporate media has this. If you've been reading whatever, Reuters, BBC, Wall Street Journal, the markets, they've had a positive spin on it. The markets have indeed been up, but the employment situation, as far as the rate of unemployment, has basically stayed the same, and the actual rate of unemployment is about the same, a little bit. I noticed there African Americans' unemployment rate has actually risen a little. It has been down, it has been up, it has pretty much all been all around. Let's do the numbers now, and this is from February the 8th here. The FTSE was down 38.09 in London. In Amsterdam, they were also down a negative. That was a negative 38.09. They are down in Amsterdam 2.29 in the negative there. In France, 8.43, and the DAC in Frankfurt was down 61.01. The Euro Stoxx 50 was down also 7.03. In Madrid, they were down 0.30. We'll go to Asia. In Bombay, down a negative 64.18. The Hang Seng was down, not as bad. It was down 89.43. The Nikkei was down 45.61. That is in the Asian markets, and it would go to the U.S. The Dow was down on Friday. It had 3 days there. Anyway, it was down, let's see, 277.26 at 29,102.51. That's what the Dow was. The Nasdaq was down 51.64. I remember when the Dow hit 1,000. long time ago. The S&P 500 was down 18.07 or 0.54%. Same for the NASDAQ, 5 percentage points. And the Dow was down a 0.94% in the negative there. And pretty much these are all of various markets here. The commodities, Brent crude was down 46 cents at $54.47. West Texas Intermediate, these are futures incidentally, with $50.32. It was down $63. They're looking at SARS there and less demand for petroleum products there, but nonetheless, T. Boone Pickens' ancestors are jumping for joy. They're at $50 a barrel. The fracking people say that they can make money at $50 a barrel, even at $45 a barrel. Nonetheless, futures, gold futures on the Forex, we'll get the PM fix, was up $9.35 at $1,572.65. So there was a jump for those in gold. Natural gas on change there was down 0.21% there. And let's see what else we have here. I don't think we have anything Reuters. We don't have CNBC around this time here. And let's see. Well, we'll see if we can get the Reuters. I don't, maybe not. I think it's basically the same things. We always like to do the Russell 200. We don't have it here. We'll try to get it in. Well, we can get the bond market here from Reuters. We try to do as much of this as is humanly possible. The bond market, the 10-year is unchanged at 1.582, and that is the 10-year U.S. bond. The German bond at 0.386, that is down 0.004, and the Japanese, that was the German. The Japanese is up 0.13 there. And the currencies are holding basically stable. $1 is at 0.9135 in the euro, and so forth and so on. So that is where those factors in the markets. I don't think we'll get anything else on the markets. We got into that. Mild weather boosts U.S. jobs. Again, that's kind of interesting there. It's interesting. From the Treasury Department, Steve Manchin said he expects the U.S. GDP to grow less than 3%, partly due to problems at Boeing's, which all the production there, less than 3%. They only got, there could be much more of that with Brexit out there, with the coronavirus out there, and various other things, manufacturing being in a depression in the U.S., you could see growth as you did in 2019, less than 2.5, around 2, and even less than 2. We don't really know at this point. We're in a Q1 how it's going to shape up, what could happen. There are just many things could happen. That 737 MAX out at the Boeing's operation is down, and the chances are, from what the airliners say, that they will not be in production until late March or maybe in the summer, that they'll get those lines back up again. There are all kinds of problems going on there. And what is happening with their subcontractors, what is happening because of the coronavirus and the supply chain in China. They've shut Hyundai down. That will have some effect, and at the rate things are going now, although people aren't seriously sick, up around 34, we say about 35,000 or so people. One of the things to remember, you don't get an exact number of the number of people that fall ill. You get more of an exact number of the people that have died. But it's now up above the number of deaths, up above what SARS had, And the virus, as far as they know, and they really don't know, has it peaked or has it not? This thing has jumped. What's happened in France? Is this by human-to-human contact, or is it moving through the air? There's a lot just not known about the coronavirus. So stay tuned on that one. Income inequality, big campaign issue in Ireland. We'll have more on the Boston Red side on the Monday morning quarterback about the Irish elections. We'll have that in by that time. What is going on in New Hampshire? So far, we don't have any indications of how the presidential race is going or not going. A lot of things will ride actually on how the economy does or does not do. This is Numbers Man in the Jerry Pippin broadcast booth. We appreciate our partner here, Cranston Analytics, as usual. And we are looking at this economy very, very closely as we get new data sets from big data. These downward revisions are going to change minds. We'll have some more PCIs from the market people, where we'll look at some of that. Some were out we didn't get in this report. And we'll have more from the Fed. We'll get more of their statistics in, and some other sources out there as to what will be done. Have a good week, everyone. And for those in business, make it a productive one. The consumer, the eye is on the prize. And we'll look further at this larger share of credit card debt, which is emerging there, and we'll look at it and its impact. Economics that affects ordinary people from the macro side, and the Fed is doing, incidentally, a much better job now of getting that data so ordinary people can look at it and get some of the alternative facts in economic punditry out of the system. Good day.